COVID has receded in the developed world and much faster in countries that have observed strict social distancing. For instance, much faster in Italy than in the US. The situation remains critical in some emerging market economies. In fact, the global number of new cases increased in May, reaching new record highs by the turn of the month. The persistence of the pandemic will slow the normalization of the global supply chains. Longer term, however, it is the demand side of the economies that worries us. Pent-up consumer demand will ensure a strong recovery in Q3. But talking of a V-shaped recovery would be an abuse of language. These are symmetrical, implying that by the end of this year, global GDP would be back to pre-crisis level. This is impossible. We estimate that in just 2 quarters, US GDP has lost 13%. This is 3 times the drawdown experienced during the Great Financial Crisis. In the euro area, GDP has dropped by about 18% from peak to bottom. Again, 3 times the shock of the GFC. The impact on balance sheet and employment are such that business expenditures and consumer spending will be durably impaired. We'll be lucky if, by the end of 2021, global GDP has fully recovered. That said, financial markets are not just about the economy. Policy and positioning matter too. Surveys suggest that investors have been rather defensive over the past 2 months. Cash positions are still large, and equity funds have not seen inflows. Then there is policy. I talked about this in previous posts. Central banks are throwing the kitchen sink. The balance sheet of G4 central banks is up almost 10 points of GDP already. By the end of the year, we should be close to 20 points. Historically, money printed has supported risky assets. QE in 2020 is dwarfing all previous episodes. Fiscal support is also ongoing. Japan has adopted 2 supplementary budgets in just 2 months. Europe is finalizing a significant recovery fund. The US Congress will probably deliver more fiscal easing, pushing the budget deficit to above 20% of GDP. Staggering. Over the past 25 years, fiscal deficits have benefited corporate profits disproportionately. This may be less true this time because the impulse from tax cuts and globalization will be missing. Still, profits are likely to recover faster than GDP. Our portfolio recommendation retains a pro-risk bias. Until now, this has been a cautious tilt, skewed towards IG credit and defensive stocks. Yet, over the past couple of weeks, cyclical assets have started to outperform. EM currencies are bouncing back. European equities are catching up with the US. Cyclical stocks are outperforming defensive. This may well continue into summer as the economy resuscitates and global investor pessimism fades. But our view of a swoosh recovery, rather than a V, argues against a full-blown cyclical upswing. Typically, we expect bond yields to stay low in an environment dominated by disinflation and central bank buying. We'll be watching FX trends very closely. The US dollar soared in March, but has now given back half of its gains. Extraordinary debt monetization, very dovish forward guidance by the Fed, and the November election may well feed the pullback of the US dollar. This would be most beneficial to EM equities, which have lagged in the recent catch-up. Thank you for listening. Speak soon.